We've seen major equity markets across the world correct sharply over the past few months on concerns around high inflation and the Russia-Ukraine crisis. Persistently high inflation has spurred central banks into action by tightening monetary policy conditions. Indian equities are down by around 15%, which is broadly in line with global equities, which are down about 16% from peak. Of course, the correction follows a strong rally in Indian and global equities, which started in late 2019 on the back of availability of vaccines and reopening of economies. With a fall in markets, equity allocation in most portfolios would have come down, and investors are probably wondering if it's the right time to buy equities. Three factors to consider while rebalancing your portfolio during downturns. First is, everything cheap is not value. In other words, just because the price of a stock or a sector has fallen doesn't mean it's attractive. One needs to assess the underlying fundamentals and valuations to build a view on whether a security or asset class is looking attractive. For instance, the tech-heavy US Nasdaq index is down by about 26% from peak, but its valuations may not still be as attractive as yet. Hence, it's important to compare growth expectations and valuations relative to history and other similar assets before deciding if that asset class is looking attractive or not. Second is focus on the long term, right? Just because an asset class or security looks attractive from a valuation perspective doesn't mean it can't fall further before recovering. This could be on account of market sentiment or other reasons. If you've got a long-term investment horizon, don't let short-term noise affect your decisions. And finally, keep in mind that asset allocation is key. Research has shown that asset allocation, or the decision on how much to invest in each asset class, such as equity, debt, and real estate, is a key driver of portfolio performance. Security selection and market timing play a limited role in driving portfolio performance. If your targeted allocation based on your investment horizon and risk appetite is, say, 70% equity and 30% debt, and the current allocation after market correction is, say, 80% equity and 20% debt, probably because you hadn't rebalanced earlier, you shouldn't consider adding more equity to your portfolio at the current juncture. If your current allocation is, say, 60-40, you could add equity in a staggered manner to bring it up to your targeted level as such. An important aspect of asset allocation is effective diversification to reduce the risk associated with a single asset class or market. This can be achieved by investing in asset classes that react differently to different market and economic scenarios. In other words, picking asset classes that don't move up and down together by the same proportion. For instance, equity and debt would tend to have a low correlation. And finally, remember the advice from Warren Buffett. Be fearful when others are greedy and greedy when others are fearful.